Hey, welcome back everyone. It is time for another red hot covered call video. Hey look, absolutely excited. I'm back behind the mic looking to do another red hot covered call video that's going to help you up your game. And today we're talking earnings reports because right now we're in the thick of it. It is July 2019, and I'm telling you what, these stocks that we've been trading are priced for perfection. And if you miss, you are going to get destroyed. Just look at Netflix that fell from the high 300s all the way down to damn near 310. I'll tell you what, you absolutely need to understand why avoiding earnings reports is a covered call golden rule. We're going to talk about it today, but I'm going to bring you the energy, give you a little excitement in what you're seeing, because I'm going to show you a trade. One of the biggest companies on the planet Earth back in 2016 would trade in these violent 10% swings during earnings. Now, a golden rule of cover call writing is to purchase great S&P type companies so we avoid volatility, right? Well, I'm going to show you one of those great companies and its volatility during earnings reports and why we want to make sure we want to avoid earnings reports as much as possible. But here's the deal. I'm going to bring you a twist at the end. I'm going to show you how you can use earnings reports for volatility to make those juicy premiums. We're going to try to do it in a conservative way, and I think you're going to like it. Hey, look, before I get going, check that out. We're getting close to 4,000 subscribers. When I put on the microphone over 2.5 years ago, I never thought I'd get 1 subscriber. If you know my story, you know that I did my videos in the very beginning for Jerry. I would show him a trade so we could talk about it at the gym on Monday. Well, I didn't know that other people on YouTube would be interested in that. And sure enough, one video turned into 2, turned into 3, and next thing you know, I have 180 videos posted. But what really excited me was that 1 subscriber turned into 10 to 100. Absolutely love it. You folks keep coming back, watching the videos, sharing your success stories, and I'll tell you what, man, that motivates me. That motivates me to come back to do another red hot video. It would be easy for me to take this time, the time that I do the videos, to put it towards my trading and make even more money. But I'll tell you what, love the stories, it motivates me, and I truly wish you all the best in trading. And that's why I try to bring you the excitement. I try to bring you the energy to motivate and inspire you, because I know a lot of you want to do it, right? You're standing on the edge, you're apprehensive, you don't want to mess up. Hey, I was there. That's exactly where I was at the time I did my very first trade, when my mentor Jerry walked me through it, held my hand, and once I did the trade, I felt it, right? And once you feel it, you own it. And I'll tell you what, man, the learning jumps off the charts. And it didn't take long before I started doing it on 1 stock, 2 stocks. Next thing you know, I'm doing it on 5 stocks. Absolutely love selling the risk to others. Hey, look, there's always a gambler out there, and they're willing to buy your risk. We get paid. That's that weekly and monthly cash flow that absolutely excites me, because most of the time we win. Most of the time when we write covered calls, we are in a winning position. I mean, just think about it. How do you lose writing covered calls? Well, one of them is if the stock falls, you're gonna lose money. But that doesn't guarantee that we lose anything, right? I've been holding Alibaba for a year, and the stock has moved in 40-point swings. If we have patience and diligence and a strategy, you're going to end up like me, where you actually make a green trade at the end. And what's the other losing trade? The idea that you don't make as much money? Look, this is the strategy to generate weekly and monthly cash flow. Absolutely allows you to make money in retirement, live the good life, or pay some bills. I absolutely love that you keep coming back, watching my videos, and banging the like button. That gives me the motivation to come back and do next week's video. Look, before we get going, if you like what you hear at the channel, I want you to subscribe to the channel. It's right there and it's free. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. And what we're doing is this. If you go to ctbdashboard.com, you can download everything from the free dashboard, which I'm going to show you later in this video. You can download all the free spreadsheets I created for free, so you keep the numbers in front of you. Look, I have a monthly newsletter that I'm about to release. We do podcasts, and I show you my running totals. Look, I bring it to you straight talk style, and I hope to motivate you and inspire you so you get in the game. See, at the end of the day, that's what motivates me to keep doing this. So let's go ahead and get to this video where we're going to talk about how important it is to avoid earnings reports when writing covered calls. But at the end, I'm going to give you a twist. I'm going to show you how you can make money using earnings reports. I know, that's crazy, right? I'm going to show you how I do it, and maybe it'll give you an idea to up your game. Okay, we're going to step back in the Wayback Machine, and I'm going to show you a slide presentation that I was going to do. I just never got to it. And what I hope to show you here is how that volatility during earnings reports can really put us in a bad spot. Going forward in this video, we are talking about a trade that happened in 2016. I'm going to try to bring it to you so you understand the volatility during earnings reports. We're talking about a great S&P type company that most people would consider very conservative, and at the time it was trading for $52. So when this thing moves in a 10% swing, this thing is moving 5 points either way. Now, I'm going to try not to use the word absolutely anymore. I'm excited, and that's why when I get behind the mic, man, I just love it. Love sharing my stories, talking about trades, so maybe you learn something. Again, this is a slideshow that I did over 2.5 years ago that I never released. It was a part of a learning series that I was putting together called The Golden Rules of Cover Call Writing. And you'll see how I visualize the golden rules of cover call writing, because it's very important to understand we have certain golden rules we have to adhere to keep the strategy as conservative as possible. You know, option strategies can be as volatile as you want to make them. But for the most part, writing covered calls is this conservative strategy that the government allows you to trade in your IRA retirement accounts. It's the only option strategy they let you do that with. Because we own the shares. That's where the covered part comes in. We're covered. So when we sell somebody the right, but not the obligation to take our shares, we have the shares to give them. So that's why it's conservative in nature. The government will let you do it. It's profitable because, like I mentioned earlier, we are selling the risk. Somebody else is going to assume the risk of paying money, a per share premium, to buy my shares at a price I pick for a time frame I pick. Remember, when you buy options, there is a deadline for which you can lose all of your money. Now, if this is the first time you've ever heard of the covered calls of golden rule, all you have to do is go to Google and Google it. There are many websites that'll show you their versions of the golden rules. But basically, there is what I consider the Mount Rushmore of golden rules of cover call writing. That includes avoid earnings reports. We always want to buy stocks that are S&P type companies, right? Those huge companies. Why do we want to do that? Well, if the stock market tanks, for the most part, great S&P type companies have profits, they give dividends, and when Wall Street eventually comes back to stocks, they usually buy those stocks up first. That's why we want to own great companies, usually stocks that pay a dividend, although that's not a deal breaker. But we also want to have open interest. And when you have open interest, you're able to write covered calls because people want to buy your shares from you. It's very important to have open interest, and usually with companies that are big, S&P type companies, have dividends, those are going to be the stocks that have tons of volume and open interest. Open interest is very important for the strike prices you're picking. Now, as I've mentioned many times in my videos, this is so important because a lot of you really don't like volatility. You know, I'll get emails where a stock moves 1 point, 2 points, 3 points, and all of a sudden you're asking me if you should sell. Look, you have to have a tolerance for the stock market. And if you're not there yet, you want to get your financial education. And with that, you want to slowly get your experience so you get comfortable with it. Because as with anything, if you get comfortable with it, man, these volatile swings don't affect you emotionally. I've told you in many videos that volatility in the stock market can cause emotional stress. And that just ruins everything. Avoiding earnings reports is a golden rule, and I mention it all the time. Now, before we move on, I believe avoiding earnings reports is the #1 golden rule for cover call writing. Most people will say buying a great stock. I would say that's up there. That's 1A, 1B. The reason for that is we have to own the stock. So we own the risk of the stock, right? So a stock can go up or down. We own that risk while we're selling somebody the right to take our shares. Remember, it's not an obligation. We are giving them the right to take our shares. So if you write a covered call and the stock falls, hey, that call buyer can just walk away. Yeah, you keep the premium, but you keep the shares. So for me, my Mount Rushmore of golden rules of cover call writing is going to be 1A, avoid earnings reports, 1B, buying those great S&P type companies. Now, I hope we all understand when a company reports earnings, that's that's the most volatile time. Usually that is the most volatile time for stock. Why? Wall Street has these expectations, so Wall Street either buys them up or sells them off, leading in earnings, and then when the company announces, right, they reveal their cards, and Wall Street either likes it or they don't. And I'll tell you, depending where the stock was trading before, man, you can move in 10% swings, no sweat. And just like my example with Netflix dropped some 50 and 60 points before it recently hit bottom. So, you can absolutely lose your shirt. If you're trying to buy stocks, play earnings reports, you have to have a plan. But most importantly, we need to do our due diligence. See, this is one of the very, very important things you need in any stock market strategy. You have to do your due diligence. Assuming that an earnings report is on a certain date, assuming there's an X date on a certain date, that don't cut it. Because when those dates drop and you miss that fact, you are subjected to that risk, right? And now you've just added tons of volatility to a trade that you didn't think you were. So it's very important to use multiple sources to get that number, because your brokerage account will have one date, Yahoo will have another, NASDAQ.com will have another. So it's very important to do your due diligence, use multiple free resources, try to come up with that best number. And then really what we want to do is we want to avoid that 30-day period. That's why we want to have multiple stocks. So we can write covered calls on stocks for the first month, second month, and then we set that stock on the bench during that 30-day earnings period. But then we have other stocks that don't have earnings and we're still generating that cash flow. That's why I always tell you, you want to have that nice basket of stocks that you'll probably go back to time and time again. But really, we want to do our due diligence so we know when a company's earnings reports and their X date. Now that's a CTP dashboard right there in the lower right-hand corner. If you've never seen the CTP dashboard, basically I load it up every single Wednesday with 100 of the best stocks trading now, and I have an earnings grab of their earnings date. And what you can do is you can verify that by going to one of the jump links I have in the dashboard. Now again, it's not the end-all be-all for information, but it begins your research. And you'll also notice that I've highlighted in red stocks that are trading in that 30-day earnings period range. Now, if it's green, it's outside of the range. If it's yellow, it's questionable. But if it's red, we want to avoid it because that stock has an earnings in the next 30 days. So here's that trade I was talking about. This is Nike. Nike is trading between $51 and $59. And in this case, I backed out the chart to really get a feel for how Nike trades during its earnings. And you could see the volatility, whether it's down 5%, down 8%, or up 11%. The volatility is absolutely jacked up around Nike's earnings. And we're talking about one of the biggest companies on the planet. It's an S&P type company. I mean, this thing's moving in swings that absolutely will ruin you if you're not ready. If you're buying Nike at the top and it falls some 10%, your premium is not going to cover your loss. And now you're in a losing position. So now you have to wait for the stock to recover, if it does, to get above your stock purchase price. Now all of a sudden you're in damage control mode and you have to be careful because the next covered call you write might be below your stock purchase price. So it really puts us in a bad spot. You really need to know that earnings date and really be disciplined. Try to avoid writing covered calls through that period. Now this was my real life trade, and as you can see, I bought Nike, I immediately wrote the covered call, and the stock announces earnings. And look what happens. Nike immediately falls. And I'm telling you right now, that is some 6, 7, 8 points that it fell. So when I bought the stock, wrote the out of the money strike, collected the premium, everything's good, right? Everything's rosy. Then they announce earnings. Here's the deal. I missed this earning report. I did not do my due diligence. I bought the stock, I wrote the covered call, and I totally did not realize that they were doing their earnings, and that stuck me. This was a really bad trade. Luckily, I was able to turn this into a green trade, but here's the deal. I had to go into damage control mode. I had to use a lot of exit strategies, really work this trade, and I added so much volatility to this trade. I didn't have to. It's because I didn't do my due diligence that I found myself in this bad spot. Now I'm going to go ahead and let you digest this screen for a moment. Basically, we have 4 outcomes. 2 of them are going to require me to do some exit strategy work. So, this is, again, just a bad situation. I did not do my due diligence, put myself in a bad spot, and now I'm working out of this bad trade. I know a lot of you find yourself in this spot because everybody does. Everybody finds himself in a spot where they did their charting, bought the stock where they thought it was a great low entry purchase, and then the stock falls. Whether it's earnings, ex-div date, update, news. Look, things can happen. This is why it's important to have your exit strategies in place, because we always manage the trade once we put on the trade. So go ahead and look at those 4 potential outcomes. And if you think there's another outcome that I missed, go ahead and put it in the comments below. So let's go ahead and wrap this up here before I get to how you can use volatility and earnings reports to make money. Let's talk about this. We have our avoiding earnings report recap. Remember, it allows us to avoid the volatility for this generally conservative option strategy. Risks become more of a factor around a company's earnings report because, in my opinion, Wall Street has expectations. They either run them up or sell them off into earnings. That puts us in a spot where we may be vulnerable, and then the next thing we know, we don't have control of the trade, right? Not that we ever have full control, but it's not working out as planned. The stock has now fallen 5-6 points. We're under our stock purchase price. We now have anxiety. We now have stress. So it puts us in a bad spot. And it possibly adds cost to the trade because our profitability will decrease, and we're going to have to use exit strategies, which we might find ourselves just wanting to get out of the trade, right? We're going to have multiple trades, multiple fees, and at the end of the day, we're not going to be as profitable. Now let's go ahead and take a look at one way I like to use a covered call when there's earnings. Now I know, again, you don't want to write covered calls around earnings reports because we want to avoid the volatility. But if you've been watching my channel, you know I love the action. And what I love to do is use these moments where a stock will run up into earnings, and my expectation is they might get a little bit of a bump higher, but they might even sell off. But here's the thing, I'm going to hold that stock regardless. And I'm going to use Win as an example because I have held Win for over a year. And whether Win goes up or down, I'm going to hold it. Now, it pays a huge dividend, and I love writing cover calls on Win because it is a volatile S&P type company. So for me, I get large premiums and absolutely love playing Win. So what I'll do is this, as Win is running into earnings, Wall Street lately has been selling off all of the casino stocks because of the China trade wars. So you have all this negative China news, and that's impacting the idea that these big casino stocks are making money hand over fist like they used to. So they sell them off into earnings, and then they run them up come the next earnings, and that's when I absolutely love to write that out of the money strike, collect that premium of about $3 or $4 with the expectation that the stock will peel off after earnings. I'm actually anticipating that Wall Street will run them up to then sell them off after the news comes out. That is a little trick that I have used probably 20 times, if not 30 times over the past 3 years. I'm looking to play that run up into earnings, and then as they sell it off, and look at that, they pay $1 dividend, so you know you're going to get that sell off. I've done this recently with 3M, where I wrote a covered call into earnings and into its X date with the 100% expectation that the stock will fall because they're going to distribute that big fat dividend. So in this case, I collect that $3 to $4 premium, but then the stock's going to fall. And when it falls and it starts to base again, I look to write that out of the money strike. At the end of the day, I play the ups and the downs, the ebbs and the flows. I take the opportunities as they present themselves to write covered calls. And then if my shares were to fall, I buy those options back, we wait for a couple green days, and we do it again. In this example, where I would write this covered call at the top, I would get $3 to $4, and when the news comes out and the stock falls, this $3 to $4 would fall to under 10 cents. And I would buy it back, I would make the difference, and we would look for a couple green days, and we would do it again. It is absolutely my cash printing machine. I have many other ideas of how I use earnings reports for volatility trades, and I want you to stick around because as we go forward into the rest of this year, I'm going to share many of them with you. And a lot of times people love using volatility for cash flow. Now, hey, look, I hope this week's video helped you up your game and you were able to find that little bit of information that might help you in your game. Hey, maybe this video motivated you. I'll tell you, if you watch the videos, if you get your financial education and you learn this, then you open up that small ball account and you get your first bit of experience. I'm telling you, you too can have the same success we're having. Hey, look, I want you to come back next week. Next week, we're going to talk about cash flow, how I generate weekly and monthly cash flow. I see a lot of videos on YouTube where they talk about how to generate cash flow. Seems like everybody wants to generate a little extra income. Well, guess what? I have 180 videos that show people how to do it. But next week's video, we're going to focus on that weekly and monthly cash flow, cash printing machine that I always talk about. Hey, look, if you like what you heard today, I want you to subscribe to the channel. It's right there and it's free. And until next time, I hope all your covered calls are profitable.